But for viewers tuning in, just to hear the press conference, it's a rate hike, the first one in over 4 years. To the governor there.
Shall we start?
Yes, sir.
Thank you. Good afternoon, everyone. Over the last 3 days, the Monetary Policy Committee carefully reviewed evolving global and domestic macroeconomic developments. We noted that global economic activity and trade has continued to expand, though there has been some easing of momentum since our April meeting. Inflation pressures have emerged in some key advanced and emerging economies, driven in part by rising commodity prices, especially those of crude oil and petroleum. Financial markets have been driven mainly by monetary policy expectations and geopolitical developments. Emerging market currencies have, by and large, depreciated against the US dollar. On the domestic front, GDP growth for 2017-18 has been revised and estimated at 6.7%, backed by an all-time high production of food grains and horticulture, strengthening of industrial growth, and resilient services sector activity. For 2018-19, the forecast of a normal southwest monsoon augurs well for our agricultural sector. In manufacturing, capacity utilization has increased, and the manufacturing PMI remained in an expansionary mode for the 10th consecutive month in May on the back of new domestic orders and exports. In the services sector, various high-frequency indicators suggest improving performance. Investment activity is expected to remain robust even as there has been some tightening of financing conditions in recent months. Both rural and urban consumption remains healthy and are expected to strengthen further. Accordingly, the MPC decided to retain the projection of GDP growth for 2018-19 at 7.4%, with risks evenly balanced around this number. Retail inflation, measured by the year-on-year change in the consumer price index, rose sharply to 4.6% in April. Even excluding the estimated impact of an increase in house rent allowances for central government employees, headline inflation was at 4.2% in April, up from 3.9% in March. In May, households reported a significant rise in inflation expectations. Manufacturing firms reported input price pressures and an increase in selling prices. The cost of farm inputs and industrial raw materials has risen sequentially. Since the MPC's meeting in early April, the price of Indian basket of crude has surged from $66 a barrel to $74 a barrel. This, along with an increase in other global commodity prices and recent global financial market developments, has resulted in a firming up of input cost pressures and persistence in the higher CPI projections for 2018-19. In the MPC's view, the price of the Indian crude basket imparts considerable uncertainty to the inflation outlook, both on the upside and the downside. Taking these effects into account, the projection of CPI inflation for 2018-19 is revised to 4.8 to 4.9% in the first half, the first 2 quarters of 2018-19, and 4.7% in the second half for both quarters, including the HRA impact for central government employees, with risks tilted to the upside. Excluding the impact of HRA revisions, CPI inflation is projected at 4.6% in the first half and 4.7% in the second half. On a careful assessment of all these factors, the MPC decided to raise the policy repo rate by 25 basis points and retain the stance of monetary policy at neutral. The committee reiterated its commitment to keep inflation at the target of 4% in the medium term and to remain vigilant on how actual inflation unfolds. Underlying the MPC's decision was the concern that headline inflation has been sharper than anticipated and that it has remained above the target of 4% for 6 months in succession. Over this period, the MPC maintained status quo on the monetary policy stance in order to carefully evaluate and monitor how the various risks to inflation have evolved. Moreover, an abiding concern of the MPC has been that the impulses of growth were nascent and taking root. In its current assessment, domestic economic activity has exhibited revival in recent quarters, and the output gap has almost closed. Investment activity, in particular, is recovering well and could receive a further boost from resolution of distressed sectors of the economy under the Insolvency and Bankruptcy Code. It is in this context that the MPC decided to raise the policy rate after a prolonged pause. Going forward, we will continue to be cautious and remain vigilant in which the balance of risks around both growth and inflation play out. I'll now request Dr. Acharya to say a few words. Thank you.
Thank you, Governor. Good afternoon, everyone. First, I'll explain briefly how the recent inflation prints have affected our projections for the year. While the April and May prints have more or less been in line with our April projections, there has been an important compositional shift. Inflation, excluding food and fuel, has hardened sharply, driven by a variety of factors laid out by the Governor, such as the oil price rise and input cost pressures. This hardening has imparted persistence into higher inflation projections for the next year. In contrast, food inflation has remained benign, and the typical seasonal pickup that one sees around this time has been delayed. This has put some softening into the short-run inflation projections. Overall, however, the ex-HRA inflation projection for the second half of 18-19 has risen by 30 basis points from 4.4% to 4.7%. And in parallel, growth indicators appear to suggest that economic revival is now on a sound footing. Given the MPC's commitment to maintain headline inflation at target rate of 4% on a durable basis, the time seemed right to the committee for raising the policy rate by 25 basis points. Second, let me turn to liquidity. As expected, the redemption of market stabilization securities in March and the normalization of bank balances have added to liquidity in April. However, higher than expected increase in currency in circulation during both April and May, as well as the Reserve Bank's foreign exchange operations during this period, have negated much of the system-wide increase in liquidity. In other words, liquidity remained in neutral zone during March and April, even though it switched back between deficit and liquidity during several weeks. In terms of magnitudes, the daily average liquidity absorption by the RBI, this is the excess liquidity that RBI mops up as surplus liquidity from the system if the net LAF operation is positive. During the month of May, this was 0.12 trillion rupees or 12,000 crores as compared to 0.5 trillion or 50,000 crores in April. The weighted average call rate at which money market participants lend to each other overnight on an unsecured basis, and which is a good proxy for liquidity conditions in the economy, this rate has remained soft, on an average 5 basis points below the policy rate during April to May 2018. It was 3 basis points below the policy rate during Jan to March 18. At the time of last policy, we had indicated that liquidity is likely to remain moderately in surplus during the first half of fiscal year 18. The few days of June so far have been in comfortable surplus liquidity condition of 0.9 trillion or about 90,000 crores. This has been driven by an increase in government spending. However, the currency in circulation expansion has remained above trend, and looking ahead, advanced tax outflows in mid-June would also reduce the system liquidity. So we'll watch these evolving liquidity conditions to determine our choice of instruments for both transient and durable liquidity management. Third, I'll just briefly touch upon a few developmental policies. The details are in the Part B or the supplemental and developmental policies that you have. One, in the liquidity facility that RBI provides, what is called as the LAF facilities for qualifying market participants, presently RBI applies a uniform haircut of 4% against eligible central government securities collateral and 6% for the eligible state development loans. This is in contrast to international standards where the haircut typically depends upon the maturity of the collateral because that reflects the market risk that the collateral is going to have. So starting August 1st, 2018, the haircut that the central bank charges at the LAF will depend upon the residual maturity of the eligible collateral. For central government securities, it will range from 0.5 to 4%, depending on 5 different buckets of residual maturity, and for state development loans in the range of 2.5 to 6%. And with a view to incentivizing the state governments to get their state development loans, get a public rating for them, we will offer a discount of 1% on rated state development loans for similar maturity compared to unrated state development loans. Second, we are planning to come out with a consultative draft regulation for market abuse regulations. At present, we have what are called as codes of conduct. These are sort of voluntary agreements within our market participant bodies such as FIMDA or FEDI. To be in line with international practices, I would say the best global practices, we plan to implement some enforceable regulations to essentially incentivize the code, that the code is being adhered to. And lastly, you might recall that in October 2017 policy, a high-level task force had been put in place under chairmanship of Mr. Deusthali to assess if and how a public credit registry could be created for India. The task force has submitted its report on April 4th. It will be released on the website of RBI today. And they have recommended that to foster better access to credit and strengthen the credit culture in the economy, the Reserve Bank should set up a public credit register. We've decided to go ahead and constitute an implementation task force that will guide us on the logistics for the next steps. I would just stress that public credit registry is one of the important ingredients of the ease of doing business index of the World Bank. Thank you.
Thank you, Dr. Acharya. May I request Mr. Vishwanathan?
Thank you, Governor. I'll highlight a few issues that have been indicated in Part B, not all of them, but some of the more important ones, and not exactly in the order which appears there. This on the MSME exposure. In February 18, we had allowed the banks and NBFCs to reckon a 180-day norm for classification of NPAs in the smaller MSMEs, that is with exposure up to 250 crores. That was limited to the GST registered NBFCs. Now we have decided to extend it to the non-GST registered NBFCs, but there is, as we go forward, an incentive for getting registered because there's a phase-in of going back to the normal 90-day norm in case of those which are getting registered, but for others it will come back immediately if they don't get registered by 31. So we believe this we are doing because we believe that formalization of this sector is beneficial for financial stability. The second part, of course, is this conversion of urban cooperative banks into small finance banks, because there's been a demand from some quarters that we must allow them to cooperatize. And we believe that small finance banks are also having the same mandate of financial inclusion as part of their fundamental business model. So we will come out with a detailed scheme on this conversion from small finance banks to urban cooperative banks, small finance banks. Incidentally, if you recall, the High Power Committee under Mr. Gandhi, which went into the urban cooperative banking sector, had recommended that such a thing should be done. Another is on the LCR. We have SLR and LCR, so we have been allowing a carve out from the SLR, which can be reckoned for SQLS for LCR as well. So we have now raised that carve out from 11% to 13%. So 200 basis points increase there to use the liquidity. On the SDLs, the current system is to value them with a markup of 25 basis points above the G-Sec rate for the of the similar maturity, with a view to improving or bringing a more realistic valuation of SDLs in the bank's balance sheets. We have decided that the non-trade state government securities will be valued based on the state-specific weighted average spread over the yield of the central government securities of similar maturity, as observed during the primary auctions. The traded securities, of course, will be valued as per their market price. We've also allowed the CICs to sponsor InvITs and reckon the investment in InvITs, the extent of the minimum required as sponsor, which is 15% today as per SEBI regulations, as part of the minimum 60% that they have to invest in equities of good companies. This will foster investment and infrastructure. That's it. Thank you very much.
Request Mr. Kanungo, please.
Thank you, sir. I'll dwell on some of the important announcement that is being made in the development and regulatory policies, that is part 2, part B. First, the payment system. And so far as the payment system is concerned, Reserve Bank has always batted for innovation and competition from the beginning. As a result, what we have today is a world-class payment system. Proceeding in that direction, we feel that when it comes to the retail payment system and the provision of the platforms, there is too much of concentration risk. So we'll bring out a policy paper in 3 months' time with a view to fostering innovation and competition in this sector, and to mitigate the concentration risk. A policy paper will be brought out which will invite the private players to bring about all India, pan-India payment system platforms. On the central counterparties in the post-global financial crisis, they have emerged as very important FMIs, financial market infrastructure entities, because they provide the guaranteed settlement risk, and so far as guaranteed settlement risk is concerned, by providing that, they mitigate the foster financial sector stability. We will bring out guidelines, a framework, providing for their capital structure, governance structure, and also the recognition of the foreign CCPs in India. Because there is international consensus that they should be well regulated, well capitalized, and well supervised. So we'll bring out a policy paper on that. We'll bring out the guidelines for that. So far as the standalone primary PDs are concerned, primary dealers, they are important part for development of the G-Sec market, while not diluting their role so far as the G-Sec market is concerned. Our effort has always been that how their other activities can be improved. They have come to us several times saying that so far as providing a bouquet of services to their API clients, they are not in a position to do so because they don't have a AD license. They are not allowed to deal with the foreign exchange. So for the purpose of providing these kind of services to their API clients only, will give them a limited foreign exchange license, authorized dealer license. So that guidelines will also be issued. Now I'll come to the when issued market and the short sale market. RBI has always tried to broaden and deepen the movement, the government securities market. With that in view, in February 2006, we allowed the short sale in the government securities, so that the participants, they can express a two-way view on the interest rate, and there would be better price discovery. Currently, only scheduled commercial banks, the primary dealers, and very well-managed urban cooperative banks, they are allowed to participate in that market. However, there are security-wise short sale limits and overall aggregate limits also on these eligible entities. So now we have decided that it should be relaxed, the limit will be relaxed, and the participation will be broadened, new entities will be allowed. Similarly, in the when issued market also, that too was introduced in 2006, and so that anyone who is eligible to participate in the auction, the short sale position can be taken only by the banks and PDs as of now. There also the limit remains, 5% of the issued amount is the limit. We will relax that limit, and will also allow it to other entities so that both the segments of this market, the short sale and the when issued in the GSEC market, it improves and the market is broadened and deepened. Thank you.
Thank you, Mr. Kanungo. We'll now take a few questions. Economic Times.
Good afternoon, Governor. Thank you. Ajit Govardhan. You have raised the rates and at the same time you have raised the inflation forecast as well. But at the same time maintain the stance as neutral, which suggests to be kind of a bit conflicting. Can you explain what it means for the future rate actions?
Actually, it is not conflicting at all. A neutral stance leaves all options open, and other central banks also do the same. So there is no contradictory, there is no difference or there is no tension between the two. The committee felt that there was enough uncertainty for us to keep to the neutral stance and yet respond to the risks to inflation target that have emerged in recent months. BTVI.
Good afternoon, Governor. Nivrita from BTVI. My question is on oil prices because of the sort of volatile moves that we've seen. At the MPR that we got at the last meeting, the MPC had factored in a $68 price for oil. Of course, since then, it's jumped to about 80, even though it's cooled off recently. That could change based on the OPEC meet at the end of this month. What is the price now that is being factored into these forecasts by the MPC? And also, does the inflation forecast factor in a full pass-through of the rise in oil prices, or do you expect it will be an incomplete pass-through?
I request Dr. Acharya.
Typically we tend to use the most recently available price in our projections. So that's the one that we have employed, and as we have flagged in the resolution, there has been a 12% increase in the crude oil price since the April policy. In terms of the pass-through, I think that is the government's policy at the present, and so that is what we assume as well.
But what is factored into the projections for inflation? Is it?
That's a full pass-through. Yeah.
All right.
Yes.
Cogensis.
Thank you, Governor. Bijoy from Cogensis here. You spoke about the liquidity side, and you have also done a SLR carve-out for meeting the LCR. But on the broader side, because there is an FX intervention strategy also that you've been working on, can you give a little more clarity to the markets in terms of OMOs, because OMO purchases especially, because you did one and you stopped, and there has been lackluster demand in the market for government securities. So if you could throw some light on what your view and what your strategy on that front is, because it has a much wider implication on your overall policy too.
Just to make a general comment that our policy regarding liquidity is determined by anchoring the weighted average call rate to the repo rate, and we have stuck to that both in terms of transient liquidity management and durable liquidity management, and that is what we will continue going forward, anchoring the liquidity policy towards the weighted average call rate. You want to add anything? Thank you. Bloomberg Quint.
Governor Gira from Bloomberg Quint. A number of emerging market central banks have responded to the volatility in the currency markets with the rate defense. What is the RBI's perspective? Is that built into the inflation projections? What does the RBI believe is the efficacy of the rate defense in the case of the Indian currency?
Our monetary policy is determined by the nominal anchor that has been given to us through a legislative process, and which is the consumer price index. Hindu?
Yeah. After the last policy, bond yields went down. When the minutes of the same policy was released, bond yields went up. So why do you think the market is misinterpreting, or do you think the market is unable to interpret what the RBI is trying to say, or that is a part of the communication policy?
Yeah, of course, I think minutes are important, so is the resolution, and in some ways if the minutes were not important, there would be no value to putting them out separately besides the resolution. I think I view the process as being quite open, transparent, and positive in the sense that different members of the MPC often have divergent views, and minutes seem the right way to convey them. But I think what is important to keep in mind is that the resolution reflects the majority view, whereas the minutes are the individual views of the members. I think that's something for the markets to keep in mind. Thank you.
So we can probably take one more question.
Dow Jones, Wall Street.
Thank you, sir. Sir, how much more pen left in the bad loan resolution process, and if there are more farm loan waivers later this year in the state elections, how do you see those things?
I'll request Mr. Vishwanathan to answer the first part. The second part is that the farm loan waivers so far that have been given have been done through the budgets of the individual state governments, and therefore the implications on the banks' NPAs directly is not there. So Vishwanathan.
See, you have taken note of the financials reported by the banks. Much of it is driven by better recognition of NPAs. And a notable feature of this is if you see the PCR, the provision coverage ratio of almost all the banks has gone up substantially. And this also we have to see in the context of the kind of resolutions that we have seen in the two large cases that have happened, where in both the cases the banks are in the money because the provisions held by them were much higher, and therefore they're going to make. And we believe that some of the other cases that are in the pipeline, if they're resolved in the same manner, the banks will have some right back in terms of provisions that they have made. So we believe that going forward, things should kind of improve.